Hello, everyone, and welcome to the Monthly Market Update. I'm John Cunnison. I'm the Chief Investment Officer here at Baker Boyer Bank. And I want to talk with you a little bit about some of the headlines that we're seeing today. And I think it's a real confusing mix of messages. So we want to put some of that in context. We're reading now about conflict in the Middle East, what that does to oil prices. We're reading about maybe some weakness in the economy. We just got a much slower GDP growth number for the second quarter of this year. And then AI. When we see AI, often what we see is, prognostications of, we're going to have job losses and that, many of these investments have gone too far. And we see others that say this is the secret to unlocking productivity and creating an enormous amount of abundance and basically unlimited GDP growth. So I want to put, again, all of that into context. So let's begin with the economy. Now, the economy grew at 1.5% annualized pace during the second quarter. That was a little slower than most analysts had expected. And it confirms, in some ways, some of the fears that we may see some slowing in the economy. But if you look under the hood, right, and let's look at what makes up that 1.5% GDP increase, again, for the second quarter. And what we see is some strength in places that we want to see strength. We saw consumer spending that was up by 3% and business fixed investment that was up over 8%. And of course, business fixed investment, read AI spending. And we'll talk a little bit more about that in a moment. And the labor market. Right now, the labor market is, I think the best word to say is that it's normalizing. Now, it's not a particularly strong labor market, meaning we're not creating an enormous number of jobs, but it's a tight labor market. And what I mean by that is we have a decreasing number of jobs that are being created each month. In the month of June, we actually created 57,000, and the expectation was that we'd create 100,000. So it was a disappointing month, but that's the backdrop, though, is that the labor pool, the number of people looking for jobs, is also shrinking. Right? So replacement, absorbing new entrants into the labor market today is something like 50,000. So even though we saw a disappointing jobs number, we actually saw unemployment fall in the month of June from 4.3 to 4.2. So an analogy I think we can use for the labor market is, we're really going from what were highway speeds of job growth and creation to what is more of a cruising speed, right? A sustainable cruising speed. So we're moving a little slower than we were a year ago, but we're still moving forward. Inflation is the next topic that I want to talk about. And of course, it's on the minds of all of us. Every time we leave the grocery store, we all look at our $150 bag of groceries and think, gosh, $150 and I've got one bag. Now, the good news is that June inflation data came in better than expected. So headline inflation fell from 4.2% to 3.5%. And that was helped primarily by lower energy prices. We did see prices at the pump fall. Core inflation, which excludes food and energy, and some of you may be saying, why would you exclude some of the most important things that I buy on a month-to-month basis? And the reason why is they tend to be very, very volatile. So trying to make policy based on really volatile data points is difficult. So they usually pull those off. And it does make sense, because when we look long-term at inflation data, when we look at core inflation, which strips out food and energy, or headline, which includes food and energy, long-term, they're the same. Right? So if we strip out food and energy, it helps to smooth out that inflation rate and makes it so we can make policy. Now, I think one really, when we think about inflation, the way consumers experience inflation, right? That's what we experience in daily life, right? That's the bag of groceries that costs $150. Economists, however, they're of course debating all the different ways that we can measure inflation. One of them is CPI, right? And that's this basket of goods, right? That remains stable over the course of a year, right? Then there's also PCE, right? And that's what the Fed uses. Now, there are some advantages with how PCE is measured versus CPI. The most important difference in my mind is that when we do see prices that go up a lot, for example, if beef prices go up a lot, you may eat a little less beef, right? CPI does not account for the fact that you're going to eat less beef. It includes beef in that CPI number at the same rate that it always has, right? But the reality is you're probably going to look at that beef price and say, I'm eating chicken tonight, right? Well, the PCE number accounts for that, right? So there's all these debates, but the bottom line is, regardless of what measure of inflation that you use or that economists are using, right now what we're seeing is that that number is higher than the Fed wants it to be. It's higher than the target of 2%, and currently, at least, it is trending slowly in the right direction. Let's talk a little bit about markets. Now, the biggest investment story of 2026 continues to be artificial intelligence, right? So global spending on AI infrastructure, so read data centers, right? That spending is exploding. So I'm putting a chart on the screen right now that gives JP Morgan's estimates for AI spending going forward. This year, they expect spending to be roughly $1.6 trillion on AI infrastructure, right? And that's more than triple what we saw a couple of years ago. And as we look forward, you can see that these numbers jump substantially. And remember, we're looking at that T is meaningful. That's trillion. These are enormous numbers that we're looking at, right? And so that has an enormous impact on corporate profitability, not necessarily for the firms that are making these investments, but for some of the firms who are receiving some of this investment. And what I mean by that is, as we build out all of this AI infrastructure, who are the recipients of those dollars? And we'll talk in more detail about that in just a moment. But they're companies that provide, chips. They're companies that provide electrical infrastructure. They're companies that provide the machines that make chips. Right? All of those companies have really significant profit growth. So when we look at U.S. corporate profits, right, this year we're likely to see growth in their earnings, their profits, of 27%. That's really substantial profit growth, right? And so I think what's really important to understand about this moment in markets is that we've seen prior moments in markets with a lot of investment, speculative investment in some future technology where there's an enormous amount of promise, but that investment goes in, it gets too exuberant, right? And for a period of time, stocks rise based not on actual earnings, but those stocks rise simply because people are willing to pay more for them, right? The prices are rising, but the earnings aren't. In this period, right now at least, what we're seeing is stock prices rising, but they are being supported by fairly significant earnings growth. And that's good news for now. It's very likely that won't last forever. At some point, we're going to have to see this level out. And there are pockets where valuations are high. But the good news is that broadly in the market, we're seeing significant profit growth. And that's important. Now, if we look beneath the surface in markets, I'm going to put another chart on the screen here. So if we look at this middle bar, you'll see that the S&P 500 has returned 9% in the first half of 2026. Well, look at the bar on the left. That's the Mag 7. Right, these are the companies we all know about, the ones that have been driving returns for the last couple of years. That's Microsoft, Google, it's Amazon. They're down 1% in the first half of the year, right? Who's really been driving then the broad market returns? Well, it's in large part been the AI complex. And what's the AI complex? Well, that's the companies that have been receiving all of this spending by a lot of the Mag 7 companies. This is 45 companies around the world, right, that they have created that really support a lot of this AI infrastructure build out. So, and what kinds of companies are we talking about? Well, we're talking about high bandwidth memory. Some of you may have heard of a Korean company called SK Hynix, right? And that's high bandwidth memory, and they're had a tremendous year. Some sell off recently, but still up a lot. Micron, right? And for any of you that have done the drive from here to Boise, you've probably seen this enormous new factory that's going up, Micron factory, huge amounts of investments by Micron. Lithography machines, these are the machines that make the very complex machines that go into chip production. And there's one company that dominates that field called ASML. They're a Dutch company. Electrical infrastructure like Schneider Electrical, and servers like Cisco and Dell. These are all companies that have had a tremendous year. And these are the companies that are, the recipients, again, of all that AI spending. So I think it's really important for us to understand what's going on under the surface, right? Great return to the S&P 500, but what's actually happening? There's some companies that are benefiting more than others. Now, a market update would not be complete without me talking a little bit about some of the risks that we see. What are some things that we keep on the radar that we should be concerned about? Well, one is obviously geopolitical tensions in the Middle East. There's not a lot we can do about that, but it does have really important implications for oil prices, and what that has implications for oil prices and inflation and what the Federal Reserve does. So it is important, but in some sense, it's a little outside our control as investors, but we keep an eye on it. Other things that I think are really important to think about are making sure that we understand that these investments that are going into AI at some point have to generate returns in the future. And so a lot of people are keeping an eye on that. We've talked a lot about it in these videos, but we're really thinking carefully about where valuations are. Are some stocks getting to prices that seem stretched to us? And the answer is yes. There are some pockets of the market that were stretched. We're leaning out of those pockets of the market and going into other areas. And those other areas are providing a lot of opportunity, right? We're seeing this big equity rally that we've seen over the last several years. We're seeing that broaden out across the market. And that's really encouraging. Now, history tells us that these really exuberant markets, right? These markets where people are very, very excited, they continue to buy, the companies that are doing extremely well, those tend to correct at some point. We don't know the timing of that, so it's really important that we think about diversification. So the bottom line is the economy remains resilient, right? We're seeing strong spending by consumers, spending by businesses, and that's important. And we're seeing profits that are coming out of a lot of this investment. At the same time, we're seeing some signs that market leadership is broadening throughout the market. More companies are benefiting, and that's important. But it reinforces the idea that we should be diversified across industry, across sector, across geography. So as always, our focus is not predicting what's going to happen next. It's building portfolios that can benefit from a broad range of various outcomes. And we're going to continue to do that. So I want to thank all of you for your continued trust in Baker Boyer. And again, if you have any questions about this video or anything else, please reach out to a member of your team and we'd be happy to help.